Well, good day, friends. Welcome, welcome. Good afternoon, good evening. It's good morning over here. So let's talk about what we're going to do today. This is our fourth session. We're going to talk about exits. And as promised, you can always catch, if you missed the other three, you can catch those. Just check your emails, find one of my emails, scroll down to the bottom. There should be links down there to sessions 1, 2, and 3. We've got 2 more to go after today. And as promised, today we get to talk about, hey, good morning, Adil. You must be in my part of the world. It's 7 a.m. here in Sydney. So today we're going to talk about the exits. Oh, evening time, Canada, I see. We've got, today we're going to look at your win rate. How is it related to exits? Which exit should you consider? How is psychology involved in exits? And can you improve your win rate with exit rules? Lots of other stuff to look at here. One of the interesting things about exits is that we have so when I'm working with traders in the one-on-one coaching group, a lot of times they're unsatisfied with the results they get from their training simulator, and so they'll ask me, and they'll say, well, how do I improve it? What can I do here? And it's not always, but it's nearly always going to be your exits. Your exits are the easiest way for you to change your win rate and the easiest way for you to change your reward risk ratio. Unfortunately, those two are sort of linked. So actually, let's talk about this. There's three sort of characteristics of trading systems. There is the win rate, which is what most people concentrate on when they first get into trading. All right. I would argue that as you get long in the tooth as a trader and you get more experience, you get better at losing, and win rate becomes less important. But that's a separate topic. The second thing is your reward to risk ratio, which most people are also familiar with. We talked about in the 43 million Forex trade study from FXCM data how most traders had a better than 50% win rate, but a terrible reward risk ratio, which means that they overall lost. That's why they overall lost, right? I would argue that another reason why is they're going against the trend, but you can go back and watch the old videos for that kind of stuff. And then the last thing, which actually it does become top of mind for some traders, which is frequency of signal. So when we're talking about exits, it's important to note that there's a negative relationship between reward to risk ratio and win rate. Okay, let me state that another way. If you have a high win rate, and high defined as over 60%, that's my definition. I'm doing the webinar, so I guess I get to choose. If you're trading a high win rate strategy over 60%, so 60, 70%, maybe even touching 80, your reward risk ratio is going to be quite low. So if you get up into the 80s, it's likely that your reward risk ratio is less than 1, even maybe in the mid 70s. You can probably still get over 1 in the 60s, depending on your strategy. Yeah, so basically high win rate equals low reward risk ratio. High reward risk ratio equals lower win rate. Okay, now the frequency of signal, this is something different. So it's almost always the case that you can find a high win rate strategy. The problem is your reward risk ratio takes a nosedive. Likewise, it's almost always the case that you can find or construct a strategy that has a high reward risk ratio reward risk ratio. So you're risking 1,000 to make 3,000, right? 3 to 1. But what happens is your win rate starts to take a nosedive. It's hard to find. You can find high win rate strategies that have high reward risk ratios. That is true. They do exist. They're the rare thing. And what will normally happen is when you find one of these that has a high win rate, I have one on the Kiwi, on the New Zealand dollar, US dollar. The problem with this one has a high win rate, has a high reward risk ratio. The issue with it is it doesn't trade very often. So this is where the third thing comes in here, right? you can often have trading systems that have really high frequency of signals. So they have a lot of trade signals, and they have a high win rate, but then they're going to have a low reward risk ratio, right? So scalping comes to mind. This is the thing. It's really hard to have all three. It really is. You know, like I said, you can, like the one I was telling you on the Kiwi, you know, that's on the weekly chart, so we don't get very many signals, but it does have a high win rate. It does a really high reward risk ratio, and it has a very low frequency of signals. So this is the important thing to keep in mind, is that these variables are all interrelated when we talk about exits. So that's the bad news, I guess. The good news is, and most people, again, don't think a lot about this, or it takes time, you know, as a trader, as you develop, you start to think about that exits are under your control. You get to decide. Nobody says that you have to use this exit for this strategy. And if they do, they're a noodle brain. You don't have to listen to them. So the important thing to note here is that you get to design your trading strategy. And this is really critical. I would encourage you to do so. Even if you find something in the Naked Forex book that I wrote, or one of my courses, or some other dark corner of the interwebs, you find a system that you like, my advice would be, maybe you should, you know, modify it, make it your own. You want to make it, you know, adjust it to the point where you're going to trade it long term. So with that in mind, let's take a look at some possible exits. I've actually loaded up Forex Tester for us today. And so I've got pound on here, and I'm just going to, free ball it here, take some trades, random stuff. I'm on daily. No, I'm on 4 hour. And I'm going to just advance the candles here, and we'll see if we can find something good. And then I'll show you some different exits. Okay. And we'll talk about okay. So, this is a breakout. Let's see here. Are we going to, actually, we're kind of just slightly above this level here. Let me back this up even further. Probably we're going to go a little bit higher at least, right? Given where the support and resistance is. I would love to see a little flag here, but I'm not sure. Okay, cool. We're going to go ahead and go long here, all right? I'm going to go long if it goes above the high. My stop loss is down here. So you got about 63 pips of risk. And we're not going to have any target, okay? So, it went. Okay, I thought it was going to go down and touch my stop loss price first, but it didn't. It based up, and it did a great explosion, which is kind of what I was thinking. It would go to at least here. See how we're up against these lows, these highs, these lows, these lows. So we're kind of in a spot here. Let's see how it reacts. Okay, I think it's going to go again. I think it's going to make another big candle up. Let's see if this happens. Medium candle up. I guess it's big. Okay, so what I'm going to do is I'm going to move to break even, and we're going to do a 3-bar exit. Okay, actually, you know what we should probably do here is we should probably change the color of the background so you can see a bit better. I think that's going to be a good idea. I thought I said no grid. I don't want to see the grid. Okay, and then I'm going to go ahead and change my candles as well so you can see those a little bit better. Hopefully this is better for you. I'm not sure if that's the case, actually. Might have made it worse. All right, here we go. All right, there we go. All right, so with the 3-bar exit, so we're at break even now. With the 3-bar exit, what we do is we put our stop loss below the low of the lowest candle of the last 3. So this second candle here has the lowest low, so our stop loss goes right there. Okay. It still is the lowest candle of the last 3 after this one prints. Okay, now we have to move it up to the big candle here because that is now the lowest candle of the last 3. Okay, we're out. Now you'll notice that what happened here with the 3-bar exit, there's no magic about 3-bar. I could use 5-bar, 10-bar, 2-bar, whatever. But what you notice here is that it retraced. It still could probably blast higher. I'd say about a 60% chance that it actually is going to do that and make a higher high than this from this, what we see here. But you don't have a lot of wiggle room when you use a 3-bar exit. See, this could go higher now. There we go. Now, if I had a different exit on here, I might have been able to withstand this drawdown, but I was unable to do it when I use my 3-bar exit. So the advantage of the 3-bar exit is that it protects your account and it gets out of a trade as soon as it really goes against you, even just a little bit, you know, like as soon as it's starting to fall apart and go the wrong way, you'll get out with the 3-bar exit. The bad news is if the market is just sitting there consolidating and waiting before it goes higher, it's going to probably get you out like it did here. Again, this was just a bullish flag / consolidation pattern here before it rocketed higher again. And I missed out on all that profit, which is from where we got out, roughly 98 pips that I missed out on, which, let's see, what was our yes, was another 1R. So we had about 71 pips of risk. We made about 56 pips, but we would have made 2R if we had, waited for this blast and gotten out like right here, right? Another one that you can use is the parabolic stop and reverse. Now, I like to modify it. I think it's, is it in here? Should be. There we go. I like to modify it. When you come with the parabolic stop and reverse out of the box, it's going to have settings like this, 0.02 and a 0.2. Okay, and it's going to look like this. Come on. There we go. These dots right here, right? And they're supposed to tell you trend. So when the dots are below price, trend is going up. When the dots are above price, trend is going down. That's kind of the idea. But instead, I use it as a stop loss. And you can see, like if I put it a few pips below the dot here, and you can automate this with a script and all that, then what happens is you can carry price like this. Now this is the settings out of the box, right? I actually like to use modified settings. So if I go to my parabolic stop and reverse, I'll make it a different color so you can see the difference. So mine is a little bit looser with my pink ones here because my step is 0.01. And that's why my settings were like that. See how this trails further away from price and it takes more for it to stop you out. It will give back more when the market retraces, when you get stopped out of a trade as a trailing exit, using as a trailing exit. However, it will also occasionally capture some giant wins. Okay, so let's think about like this. Let's say some reason you got in here on this kangaroo tail. If you're following the pink dots here, you probably withstand. On the blue, you're out here. Okay, if you're using the normal PSAR, you're out here. But on the pink, you might have actually survived this one here if you have a few pips below. I'm not sure. And if you did, then you're out all the way up here, which is a lot more. And that's the advantage of using this one. Let's see actually if we were using our let's do this. So we're still in the trade here, and we're going to use our parabolic stop and reverse with the modified settings here with step at 0.01. And my stop loss, oh, I know. Oh, okay. So should I just take another trade? Okay, we'll do that. Fine. So I'll put my buy stop above the high here. Why is this? This should keep going, right? Yeah, okay. Is it still going? Yeah. Yeah, okay. It's still going. All right. My stop loss is right there. So I'm going to go ahead and modify my order and put it right below this dot right there. Okay. So I'm right below that dot. Now it's flipped to the other side, so it's going kind of bearish, but that's just because it's consolidating, and I would keep my stop loss at the last lower dot here, right? Okay, until I'm out. So you can see this made a bit more. How much more did it actually make? Because I think we were out over here, so it made about, yeah, about 35 pips more, something like that. So another half of an R or 0.49 R, something like that. on the modified parabolic stop and reverse. Let me show you another one. Here's another one where we're in the trade back here. Okay, we're in the trade, and then what we do is we go, all right, I'm gonna get rid of all these now because they're bugging me. I'm gonna use a moving average. So, and by the way, I'm not sure if you can see the link there, but if you can see the page, here, I'll post it for you. This is today's commercial. Today's commercial is this is the private forum here, and you can see we've got a bunch of courses down here. Our London conference recordings, they're really high quality actually. Mental shortcuts, risk management course, free money trade, firsty trade, Acapulco trade. You get what you trade for, patterns in your psychology, and why do you do things over and over again. Naked Profits course, these are systems not in the Naked Forex book. Daily Trader, 365 videos on systems, psychology, and risk rules. Personal trading program, this maps along with the book. Naked Forex, Forex Tester course, Pro Trader course. A lot of these are in Naked Forex, and some of them aren't. And so a lot of what's going on here is you can see my trades. I post my trades. We've got psychology stuff, automated trading stuff. It's all in here. And if you click on the link in or the page that I think you probably see a page. Don't forget the chandelier exit. Yeah, that's right. I don't know if I was going to talk about that because it was kind of it's kind of tricky. So yeah, Jim said, look at the chandelier exit. Don't forget, because he loves it. He loves that one. Sneak peek. So it's right here. This is the link for your, if you're interested in having a look at the, I put it in the chat box there. Okay. So if you're interested in the forum, that's what's in there. So let's talk about the next one, which I want to do is the moving average slope. All right. Moving average slope is pretty good. I'm going to use a 9-period simple moving average, which means it's going to take a lot to move that because it's simple and not exponential. So I'm going to be in this trade here until this moving average starts sloping downward. Okay. So that's the idea here. Again, if it consolidates for some time, it'll start to flatten out. It's not going down though. See how it's still going up. I can check that by saying, what was the setting here, or what was the level? It was at 1.8992. And then, boy, the pound was pretty high back in 2006, wasn't it? And then 1.8996. So it went from 92 to 96. So it's actually still going up. Still going up. Okay. Still going up a bit. That was 2 pips. Oh, there we go. We went. So we're still holding this one. Now, it isn't that some people can get this confused. It isn't that your stop loss is on the moving average. It's that the moving average tells you when to get out. Okay, so the moving average is an alert. You can actually download moving averages that change color when they go down, when they slope down or up, so you can see it quite easily. But you can see it easily enough without having a special moving average. So we're still in the trade here. Now, wait a minute. This is 1.9078. This is 1.9077. So at this stage, it's gone down 1 pip. It's game over. Okay, so we close our position. What? Why does it say it's up $9? It doesn't make any sense. That was a very small lot size, wasn't it? That doesn't make sense. Okay, whatever. All right, the lot size is messed up on this. What was it, risking like $2 or something? That's ridiculous. Anyway, so there you go. So and then again, if I'd like to give you a bearish example here. Let's see if we get one. If we fall here, I might take a sell. We're not going to fall. We're going to go sideways. All right, let's get a bearish trend here. Anyone? No, still going to go bullish. Okay. Yeah, right. Okay. Yeah, dollars in the toilet back in 2006, clearly. Yeah, the euro was really strong too, I remember. Okay. Yeah, it's there's a big shadow there. Yeah. All right. So that's another one. You can also use an R-based one. Let's do that. Let's wait for a trade. Whether or not we do our buy or sell here, we might have to do another buy. I'm not sure. Let's see if we get. It'd be great if we could get some bearish action. There's a bearish big shadow there, but we're still kind of in this box. See if we can break out of this box and go lower, maybe. Any chance? Maybe. We're sitting around here for a while. It's all right. If we get another breakout to the upside, I'll take it. So I'm just going to do this now. I've got my top of the box and my bottom of the box. Okay. Oh, okay. Let's see if we break. We should come back. All right. I'm going to go ahead and use a sell stop here below these lows. Okay, there we go. I didn't have 1% risk tick. That's why that was such a low risk amount on that last trade. And my stop loss is going to go up here, halfway up this, or 3/4 of the way up this big candle. Okay, let's see if we actually take. I actually like this better now. I might put a sell stop below this candle. Oh, of course. Now we're going to get stopped out. All right, let's see if we touch our level here. I was waiting for the last kiss originally. Probably should have done that. This is a kangaroo tail, but it's not a very good one. It's really small. Let's make sure that we don't close back inside the box. Okay, cool. This looks fairly good. So we'll do a standard last kiss with a sell stop here, 1% risk, and the stop loss up here at the midpoint of the box. We're in. And what we're going to do, oh yeah, an R-based. So the risk on this from entry to stop loss is 212 pips. Okay, 212 pips. It's quite a lot on the 4 hour, but it is the pound, and the pound is at a high level here. So it's very... Okay, so what we want to do now is I want to fall through this floor, and then I can start moving it. All right, we're back inside the box. So the rules of the last kiss are to close out the trade. So that didn't really work. You normally wouldn't have your stop loss hit. It's kind of an emergency stop. All right, let's see if we can get a good trade here. I'm just going to wait for the market to trend. I don't really care which way. We could take a sell off this kangaroo tail here. Let's do that. So we'll put a sell stop right here below the low. Our stop loss goes above the high, so it's 146 pips of risk. We'll just make it 145 just to make it easy and place our order. Okay, so if this triggers, what I'm going to do is oh, it's not going to trigger. Okay, it's not going to trigger. We'll get one, guys. We'll get a trade. All right, we're above the box. Let's see if we can go. No, false breakout. I'd like to just move one way or the other, really. Okay, here we go. This is probably going to be a bearish flag, and it's probably going to fall from here. Let's see. It may come back up here, but it may also fall before. I think we're ready for a big, fat, bearish candle. Nope. I'm wrong. There we go. All right. So a big shadow here in the middle of a bunch of traffic, which is not ideal, but it did engulf the prior 2 candles. So I like it enough to take it. And my stop loss is going to be 93 pips. Actually, we'll make it 90. It just makes it easier for me to manage it. And let's see if we get in. We're in. And we're going to get stopped out. Yep. Okay. We'll keep... there's an even better big shadow. We'll put a sell stop here. And we'll put our stop loss up here. 190, we'll call it, of risk. Let's see. Are we going to break through the floor here? Yes. We are completely stuck in consolidation. All right. We'll wait again for another trendy move. There we go. Trendy kangaroo tail will go long. Why not? Pound's on fire. So we've got a risk of about 80 pips. And if we can get a runner here, I'll show you what I was looking to, what I was hoping to show. Okay, one principle I use is when I have a kangaroo tail, if we have 2 candles and it doesn't go, then it's too late. If we have 2 candles that are printing down in the belly of the kangaroo tail, even worse. That's a really bad sign. So my rule on this would be to just disregard it now. I don't care if it goes, and I don't think it will anyway. So you can see it's still sideways. We're actually not trending. That was a little bit of a fake out there. It was like a burst higher. We're still waiting for a trend. Either way, I don't care. We just want to see something exciting here. So I'm just gonna rip through this until here we go. Maybe we're gonna clear these highs over here. Nope. Completely stuck. Completely stuck. Okay. So a bit of a channel here, maybe. Probably hard to make that work. Okay, there we go. If we can get above these highs, I'd be very excited. Ooh, that looks pretty good. Let's see. Yep, I think it's going to do it. Okay, cool. All right, now I'm just going to wait for a pullback. Just going to wait for a pullback here. I think it's going to hop higher. Yep. Okay, I'm just going to put my buy stop above the high here. This is like a sort of like a Darvis box style trade with 55 pips of risk. Perfect. All right. Can we get out of this box? Ooh, that was a bit tricky, wasn't it? That was not nice of Mr. Market to do that to us. I was hoping it would be a giant candle. If you put these 2 candles together, you'd have almost a kangaroo tail, but not good enough. I think we're going to go now. So I'm going to put my buy stop here and my stop loss down here. We've got 90 pips of risk. There we go. Now, hopefully, we're going to go. We've consolidated for some time, but hopefully we're ready to, I think we are. I think we're ready to trend. Excellent. So now, what are we up? 71. When we go 90, I'll move to break even. Assuming we go 90. Okay, 89.4. Close enough. So I move to break even. Now, I don't have to do that. I can actually move to 0.5 R, right? I could put my stop loss at, 45 pips, for example. But in this 1 R exit, ladder exit, we're just going to wait for every 90 pips. So if it goes 190 here, and by the way, if I'm trading this, sort of in real life, I would be looking to add positions here. One of the big mistakes that we make as traders is we don't add positions when we're in a trending market. So I'm at break even with this position, so I would open it up and say, if I got any more positions, I'll take them. I don't want to complicate the example here, so I'm just going to leave the 1. But this is a big mistake that we make when we trend follow, is we don't take all the signals, because that can literally be the difference between a winning strategy and a strategy that that doesn't quite work. Oh, look at this. So this, for example, could be a trendy kangaroo tail. Yeah, right there. See, it took out at the very next candle. All right, so are we up 190? No, not yet. Oh no, or 180. We were close. Trendy kangaroo tail not so hot now. Oh, okay. Trendy kangaroo tail looking good. Okay, I have faith that we're going to get to 180. Oh, there we go. 180. So now we lock in 90 pips of profit. See? So this is the ladder exit. What's the advantages of this one is, unlike the parabolic stop and reverse, and even the moving average slope, and the 3-bar exit, the actual price action and how the candles print are absolutely irrelevant. Whereas with those prior 3 exits that I showed you, all of the price action movements are going to impact whether you get stopped out or not on a trailing exit. That is not the case with this. As you can see, it doesn't really matter what it does as long as it stays within a certain range. And because we didn't get down to break even down here, we're still in the trade. Okay. Oh, are we at 270? We're not, but we're nearly there. Oh, I'm going to move it now. I'm going to move this 180 because we're close enough to 270. We're at 260, right? So I'm going to go to 180. So we've locked in 180 now. Here, where are we? Where are we? Right there. Okay. Okay, we're gonna go again. Hey, so we're at 270. What's after 270? You gotta know your nines multiplication table. 36, right? So 27, 36. So 360. We need 360. We've no, not quite there yet. Oh, 320. 300. Oh, you dirty rat. Back to 270. Come on. Give us 360. Please give us 3. Okay, maybe we'll get it. Maybe we're going to get it. 340. What was the high on this, though? I think it's going to go again. We got it. Excellent. So now we get to, this is when we high five ourselves and talk about how good we are as traders, and then we draw a straight line to the moon. because we had one winner, right? Of course, you know, if I had taken this trendy kangaroo tail down here as well, or maybe this big shadow right here on the pullbacks, pullback, trendy kangaroo tail, pullback, big shadow here. You know, I've got multiple positions here, and I'm really doing well. But I just want to keep this example simple. So what's after that? 42, right? So we need 420 pips. I don't know if we'll get that. 420 pips before we move. You're kidding me. We got it. Okay. So we are high-fiving ourselves. We're the best traders ever. And we're at 360 pips here, right? That's close enough. All right. So we're still in the trade. Notice how much we would be making if we had this one and this one in as well. And what's after 420? We are looking for 490. So we need 490 before we do anything now. We're at 450. 470. Boy, that's almost 480, isn't it? That's pretty close. Oh, 490. You're kidding me. All right, so we're at 490. I have no idea what's going to happen on these, right? We just lucked into one. 490 is right here. Wait. Oh, 490. I should be at 420 is where I'm at, right? Yeah. 420, right here. Okay. So we're at 490. My stop loss at 420. Got it. Okay. Getting confused already. Ooh, we're back up to 520. So 490 plus 50. Am I doing this right? 9 times 3, 9 times 4, 9 times 5, 9 times 6 is 54. So 54 is what we're looking for. That's right. Okay. 54. We are looking for 54. I believe that's right. 54. I feel like I went to my multiplication table for sevens. All right. 54. That's close enough. So 9 times 6 is 54. 9 times 5 is 45. So I'm at 45. That's where I should be at. Right? 45 right here. So now we're looking for 63. No. We want 63. We don't have 63. Okay, we got 63. So we got 63. So now we're at 54 here. Right here. And we're looking for 72. 720. Oh, we're going to get stopped out. Okay, there you go. So that is the R-based exit. It's not that the R-based exit is the best. It's just we got a really good example for that one. But you definitely would have been out on the 3-bar exit here, right here. The moving average slope probably here. And maybe even the parabolic reverse, parabolic support. Actually, let's look at that. Let's have a competition and see. So your parabolic stop and reverse gets you out here. Okay. Now, I could have had a moving average slope. Remember I used the 9 and the simple? That's very slow to move, so it doesn't move as quickly as an exponential. An exponential moving average has a magic number that they add to the formula to make it more sensitive to the most recent candle. So just wanted to show you the difference between the exits here. So we would have been out here on the parabolic stop and reverse modified. So that's the looser one. The moving average slope, I can tell you for sure, would have been out around here, maybe here, but definitely by here, and certainly by here. And then your 3-bar exit is out like, might have your 3-bar exit might have even been out right here on this long tail. Let's see. Where's my trade here? 3-bar exit. No, you're okay until here. Yeah, right here. 3-bar exit is out right here because this low is lower than the last 3 candles. So you're actually out. You would have been stopped out here on the 3-bar exit. So that's the difference, guys. So when you're thinking about your exits, it's a balance between, am I going to, try and make as much as I can out of my trades, or am I trying to protect my account? So if I'm trading someone else's money, I might use a more protective stop like the 3-bar or the moving average slope. Obviously, I can change the dynamics of the moving average slope by using a high moving average. Most of the traders I know, they'll use a moving average slope between 5 and 10. I used a 9 to kind of make it loose to show you that, and it made it simple instead of exponential. But there's nothing stopping you from using a 20, except for the fact that you're going to have some terrible drawdowns before you finally get popped out. So it'll be like the modified PSAR. It will give you some really great winners, but you're going to get a lot of really small wins and small losses as well along the way. So so that's so there's a couple right there. Any questions about any of this stuff we've talked about so far? Yeah, you can use VWAP, you can use Chandelier. They're all great, but it just comes down to your what do you want to do, right? What are you trying to accomplish? What is your goal, right? You could use reversal signals. The reason I don't like using reversal signals is because when you're in a strong trend, you're going to get reversal signals that are absolutely blasted all along the way. So, we see like a reversal kangaroo tail here. We have a reversal big shadow right here. So one of the reasons why I like using open position ratios is it gives me a clear bias. And so I just ignore this bearish big shadow. I ignore this bearish kangaroo tail. I'm ignoring all this stuff along this kangaroo tail here. I'm ignoring them because I'm so long. I'm very long because I think the trend is up. So so that's one thing I would say about that. Let me have a look at our notes here. So is my win rate related to my exit rules? Yes. The looser. The more aggressive. So we talked about trailing exits here. We can talk about targets too. One thing that you might do. So I knew a trader. He was pretty good, really good psychologically, because he dealt with so many losers. He had such a low win rate. But what he would do was he would actually have a rule where he would use the R-based exit, R ladder. It's called the R ladder, right? R is just the amount at risk, right? So if you're risking $500 or 50 pips or whatever it is. But when it got to 5R, he would actually shoot for 10R. So he had this, it was like, it goes 1R, he moves to break even. It goes 2R, he moves to 1R. It goes 3R, he moves to 2R, and so forth. But once he got to 5R, he would keep his stop loss at 4R, right? And he would shoot for 10R. Because his data showed that if the market was going to go 5R, there's actually a really good chance that it was going to go 10R. So you might want to look at things like that, right? Are there other examples where you could possibly change the rules a bit. It's sort of like what I was saying before. When you move to break even, there's no rule that says you have to move to break even after the market goes in this amount of profit. You might just move to 0.5R risk. So you're taking half the risk you had initially. So that's still allowing the market to zig and zag a bit before stopping you out. One of the big problems with break even stop loss rules is it means that you're going to end up with missing out on quite a few trades. In fact, a lot of times when you actually do the testing, you'll find that break-even stop rule will reduce your profitability. That's true, and I've done that. I've done those tests, and that's usually what it comes out on. Doesn't mean you should not use break-even stop loss, because, like I said, if you're trading someone else's money, if you're trying to, get established on one of those prop firm, things where they have 5% drawdown typically. So you need stuff like that. You need to have really low risk, and you really, most traders, they'll risk 1% or something, and that's why they blow up and they don't qualify. Instead, they should be risking something like 0.2% or 2.25, a quarter of a percent, something like that, right? To really make it work. Using break-even rules will really help you because you're just less likely to have a deeper drawdown. So it doesn't mean it's more profitable though, right? They're two separate questions. So yeah, all right. And then any other questions here? Which exits? So with targets, when we use targets, our target is going to impact our win rate. We talked about that. It makes sense, right? If I have a 5R target. Okay, well, let me ask you. If I have a 5R target, so I'm risking $1,000 to make $5,000, what does my win rate have to be to make money? I've got a 5R target. What does my win rate have to be for me to be profitable? So, Michael, what I do personally, James says 23. Yeah, you got to just be around 21 to 23. Yeah, that's right. Yeah, we'll talk about that in our next session when we get into risk. So if you're over, probably with the spread and commissions and all that, you're probably talking at least 21%. So 20, 21, 22. Once you get into that area, you're definitely profitable on a 5-to-1. Matthew in London, he uses 20-to-1 exit, and he's successful 9% of the time. So he has a 91% loss rate. He has a 9% win rate, and it's automated. He's automated it because he's smart enough to know that he wouldn't keep taking trades if he had 27 losers in a row. But he has a 20-to-1. So a 20-to-1 means what? He only needs to have over 5% win rate, and he has a 9% win rate. So he's convinced that that's the best way to trade. For him, that's the best way to trade. He sets it up. It's automated. He goes for 20-to-1, and he's fine because he's got a big fat profit cushion as long as he's risking the right amount, so that he can live to see his winner, his next winner. He's fine, right? So, and we'll talk about this in our next session when we get into risk. Okay? Yeah, really interesting. All right, so we talked about, is my win rate related to my exit rules? Yes, you can increase your win rate by how? How do you increase your win rate? I want to make sure we go over everything we talked about. We would. You can increase your win rate by making your exits easy to achieve. So if I have a 0.5R target, I'm going to have a really high win rate. Think scalpers, right? On the other side of it, I can completely reduce my win rate by doing what? By having a really tight stop, right? A really tight exit rule. So if I have a 1 pip stop loss, so if I get in a trade right now, let's go to the euro. Let's go to the euro right now. I know it's interbank market right now, but that's okay. Is it interbank? No, not quite yet. We're not even at the end of the day. Okay, so I'm going to go to the 1 minute chart here on the euro, and you can see here. Here, let's go to the 1 minute chart. So if I took a trade right now on the euro and I sell, I'm selling at 55, and I put my stop loss at 56. Let's just say 57, right? Because I know there's a 1 pip spread. So I'll put my stop loss at 57, right? So if I got in right now, am I going to get stopped out? I just want to see if this gets to 57. That's what I'm looking at. Is this going to get to 57? Because I sold at 55, right? If this gets to 57, I'm out, right? My trade's over. So that's how I can reduce my win rate by having a really tight stop. And it's going to go to 57. It's going to stop me out. Let's see. We're at 56. Oh, there it is. Boom, stopped out, right? So I just got stopped out on my 1 pip stop loss. So you take it to the extreme. If you want to see what the result is, you just take it to the extreme. That's what I usually do. What would happen if I had a 10R target or a 20R target like Matthew does? Matthew has a 20R target, and he has a 9% win rate. Okay, if he had a 0.25R target, he would probably have, something in the 80s as a win rate, or maybe even high 80s, right? So that's how we know. Okay, which exit should you consider? The ones that make sense to you. So VWAP makes sense to you, or Chandelier, those are the ones you look at. Did I answer Michael's question? So for what I do is, so I have different rules for different strategies, but essentially my base case rules are, when I hit my first target, I move to break even. And that is usually a 1R or 2R target, depending on the strategy. So if I move, so I'll split up my position into two pieces, maybe 0.5% on this, 0.5% on that. And if I hit my target of 1R, or it's usually like 1.1R, a little bit more than 1R, then I will move to break even, and then I'll use the trailing exit on the remaining position. Or if I have a 2R target, same thing. Once it's 2R, I move to break even. I generally, if I see it, and let's say that I have a 1R target or 1.1R target, and I see it at 0.9R, 0.85R, I'll usually move to break even then, if I see it. If I don't see it, that's okay, I don't care. But if I wake up in the morning and the target's been hit, I'll move to break even. You can also automate all that. I like to automate the exits on the trailing exits, so you don't have to worry about that. Like with an EA, yeah. Why is the USD so strong after the rate cut today? Yeah, the fundamentals get weird, don't they? It's probably So this is the whole bad news is good news and good news is bad news sort of thing. I think the thinking is that the stock market's going to rally, you know what I mean, because of the rate cut. Everyone thinks that rate cuts are going to save the markets. Oh, I guess not. Yeah, I don't know then. My fundamentals are, S&P just tanked. Oh, that's so funny. Yeah, I don't know. I don't know why. You know what? A good place to go if you want to look at fundamentals is FX Street. Here, I'll show you. We can look. Yeah, that's a good question. Normally, they it was like, oh, stocks will love a rate cut sort of thing. Is my website not working, is it? FX Street is not coming up. That's weird. Huh. You guys are still here, so my internet's fine. Oh, maybe it's not. Are you guys still here? Can you hear me? It was hawkish cuts. Dot plot goes from 4 to 2 interest cuts. 4 to 2 interest cuts next year. Oh, so they signaled lower. Okay, there you go. There you go. See, Jim? There you go. FX Street is down. Wow. Is that right? Just want to make sure I've got... Yep, okay, so it's not my internet. It is that FX Street is down. Okay, or just really slow. Something like that. Okay. So if you go here, so hawkish Fed, and then we've got Bank of Japan coming. So they cut it by 25, but what Michael is saying here is that they signaled slower cuts in the future. So that's why the markets are. So the cut was sort of expected, and that was built into the equation. What happened was they said, look, we're probably not going to cut next year's 4. We're going to cut 2 or something. That sounds like what's going on. Look, I don't pay a lot of attention to it. I know when I knew, like I had a trade on last night on the pound CAD, and I knew that, it would probably zig and zag a bit given the rate cut. What would have really shocked the market if they didn't do anything, right? Or if they raised rates. If they would have raised rates or did nothing, everyone kind of expected that they would do what they did. But I think the unexpected thing was that they said, we're not going to cut as much in the future. Exactly what Michael's saying. Yeah, that's right. Jim and Michael, you guys are all over it. Okay. Cool. All right, guys. I think that's it. I think we've covered everything. In our next session, you'll look for the email on that one. Probably it'll be this weekend or next week, depending on where you are. And if you're on one-on-one coaching, we're going to have our session as well on Sunday, I believe it is. Yes. So we'll see you at the one-on-one coaching session. But our next session 5 of the workshop, it's going to be risk. We're going to talk about risk. Why is risk important? How do you improve, or how do you change your strategy with risk? What can you do? What are the things that you can look at? All right. I really appreciate you guys. I hope you have a wonderful weekend. I guess it's not quite the weekend, is it? It's Thursday over here, but thanks so much, Michael. Thanks, Himashu. Himashu, if you check your email, the emails that I've been sending about these workshops, just go down to the bottom. Go down to the bottom of the email, and at the PS, it has all the links to the previous sessions. In fact, the next email I send will have the link to this session. So yeah, should be down there. Thanks, Emma. Have a good night. See ya. Bye. See ya. Bye.